Countdown to the open. I'm Lisa Abramowitz in for Jonathan Ferro. Just moments away from the start of trading. NASDAQ lower by 0.5%. S&P fluctuating between gains and losses. The story has been the yield story, which have paired some of their advance. You had seen at one point 4.33% on the 10-year yield, now down below 4.3%, but really driving the action with this feeling of dollar dominance and yields ever higher. You are seeing that 10-year yield off the highs. The euro dollar is still seeing that weakness in the euro. Dollar strength 97.68, and you can see the yen climbing at one point very close, bumping up against 152 with the dollar stronger versus the yen. Joining us now with a look at the stocks moving ahead of the opening or at the opening bell. Here's Katie Greifeld. Katie.
Lisa, I have to start with Snap because it posted the slowest quarterly sales growth ever. You had advertising spending just absolutely in the gutter, a potential warning sign for other social media companies, but all the action in Snap this morning down about 27%. American Express, too, under pressure. It's still seeing good spending, but that strong dollar eating into guidance, and Amex, it set aside more for bad loans than analysts had expected. Shares off about 3% or so. But let's get to some good news. We're going to do that with CSX. Shares higher after the railroad operator beat estimates. Profit was up 21% year over year. The company also reiterated its full year guidance. Shares higher almost 3%. And Schlumberger posted its highest profit in 7 years, largely thanks to a big overseas pickup. You have drillers putting oil and gas rigs back to work. The company also said that sales and margins should expand in the fourth quarter.
Katie, thank you so much. Earnings season very much underway. Separating the haves from the have-nots. Bloomberg's Kaylee Lyons joining us now with the scoreboard. Kaylee.
Well, the scoreboard actually looks relatively decent, Lisa. When you look at the S&P on average, about a fifth of the way through earnings season, we are seeing earnings down about 1.7%, but the majority of companies are topping expectations, and that includes a lot of those that have seen the most reports already. We have seen about half of the financial sector reporting. 75% of those names have topped expectations. For staples, industrials, communications, all between 20 and 30% of the sector has reported, and we've seen very decent beats there as well. So a lot of those companies are getting rewarded. In the communication sector, for example, Netflix is one of the big ones that saw a nice post-earnings boost of about 13%. We've seen a nice lift for Lam Research, AT&T as well. But when you miss, you do indeed get punished. Union Pacific off 7% the day after its report. Comerica by 9%. M&T, those regional banks, getting hit pretty heavily. It was down about 14%. So as for how that translates onto a sector basis, in the last week we have seen media and entertainment doing fairly well, as well as the airlines. They are still raking it in. A lot of people want to travel even though fares are very, very high right now. The airlines index up about 2.7% on the week, but elsewhere in transports, it's a very different story. Look at the trucks. The trucking industry and the railroads, transportation down about 1%, and consumer durables as well, about 1.2% on the week, Lisa.
Kaylee, thank you so much. Social media stocks very much under pressure. That Snap decline, the biggest going back a long time, the most since July, just tremendous. It has paired some of those losses coming ahead of a monster week of earnings. Meta and Google on deck. Bloomberg's Ed Ludlow joining us now for more.
Ed. Yeah, this was a stock that in November was trading above $70 a share. How things have changed. We're now much lower than that, below $8 a share. One of the big questions is all of the issues that Snap outlined, a pullback in budgets among a broad range of advertisers, macro headwinds, the impact of inflation on the consumer. How much of this is transitory, Lisa? How much of it is specific to Snap? And most importantly of all, as we get into the meat of this earnings season, how much does this spread to other names? We have an incredibly tough week coming up next week with the likes of Meta, the likes of Twitter, although there's slightly artificial trading around that subject to the purchase by Elon Musk. What are they experiencing with the ad market here, and what do we read into this situation as a lens into the health of the consumer? You also have a slightly different take, of course, through Alphabet, the parent company of Google. You and I discussed this earlier. We went into this with a mixed opinion about technology. Potentially the third quarter could have seen EPS hold up better in certain corners of the technology market. My goodness, are the list of problems and headwinds growing. I'm still excited, though.
Ed Ludlow, thank you so much. I'm excited, too. I think it'll be helpful to see exactly where things are at. Yields, meanwhile, continuing to soar higher and hitting pause on the latest equity rally. Investors wondering, is the honeymoon already over?
This is a very impatient market.
You don't want to get too comfortable.
It's way too early to say capitulation. I mean, I think that's heroic.
The Fed just started raising rates this March.
We have not seen the real impact of tighter financial conditions.
That means bumpiness in the market.
We've seen the market sell off a lot.
Investors seemingly have no tolerance for pain.
That potential capitulation. There's still work to be done.
We're going to get these bear market rallies.
The bear market rally, it's short, it's sharp.
Companies are battening down the hatches and getting ready for choppier times.
Before we can say this bear market's over.
We need to see some of that weakness coming through.
We're going to be on this roller coaster to nowhere.
The roller coaster to nowhere that we're all on. Amundi's Monica Defend joins us also on that roller coaster to nowhere. Based on the roller coaster of yields ever upward, at least so far, how much have equities fully priced that in?
Well, we don't think that equity actually ever really priced in a prolonged recession. But if you ask me what are our working assumptions, we do frame the current outlook within an environment of earnings recession for this year and prolonged for longer higher inflation. And this is obviously reflecting into the equity path because the central banks on the other side, they remain quite hawkish. So let's see how much and what the terminal rate for the Fed, for example, will be. We stay between 4.75–5%. But this is what is really concerning investors amid earnings that are running under margin compressions and cash flows that have been reducing so far.
Right now, really the news of the morning has been in the yield space, with yields climbing to the highest level in the U.S. going back to 2007. Real yields also climbing to the highest levels that we've seen going back to 2009. And then there was a bit of a retracement after a Wall Street Journal article came out written by someone known as the Fed Whisperer, talking about how Fed officials are looking for a 75 basis point rate hike at their November 2nd decision. And then after that, more voices saying to pause. And how much, Monica, is that really a deciding factor for you in terms of how high yields can go, whether those naysayers on a Federal Reserve can really get their way and cause some sort of think, pause, wait for that lag time to take effect?
Well, we're pretty convinced that November and December we'll see no-kish Fed, so we are penciling in a 75 hike each. Then when we move into January and February, we'll see, but we do believe they will continue to hike, and it is unlikely that they will pause because it's their credibility that is at stake. So, and this was really, really clear to us last week at the time we've been joining the IMF meetings. If you look at the textbook Taylor rule, 6% terminal rate is what theoretically might help the Fed to go back to target in 2024. But in order to get there, the price that we are gonna pay in terms of earnings, margin compression, higher yields, and economic recession is definitely non-negligible.
Wait, 6% terminal rate, is that plausible to you?
I think that they will stop earlier, just because it is true that Powell at Jackson Hole said there will be pain to come. We really need to be focused on inflation, but such an increase, such a fast increase of rates might be detrimental at some point to fiscal stability. So as of today, hard data remains quite good, but we are seeing some cracking the soft data if you look at the confidence indicator. And I don't think that really they can ignore all these kind of costs when it goes to fast increase of rates.
Well, perhaps they can't get to 6%, but the team over at BNP Paribas expects rates to rise past 5%, writing, quote, "We now expect a terminal Fed funds rate of 5.25%, thereby lifting policy rates to a sufficiently restrictive stance to cause recession. The recession is likely to start around Q2 2023 and endure for 3 to 5 quarters. Monica, from your perspective, how much does that really make the argument for cash, for remaining nimble, for not being overly invested as the markets catch up with a view that is increasingly higher yields and a Fed that has to do more?
At first, I agree with the fact that if we move into 6, we might have a prolonged recession that might last several quarters going into 2024, even before you see inflation cooling down. Having said that, it is really important to look at how the economic partner will evolve, and cash is a decent hedge, if you want, vis-a-vis this margin compression that honestly, when spread compression, that honestly, when we look at spread, they've not been moving that much, and this is kind of weird, no? Because it means either the corporate sector is quite safe, and we do believe that they might have some solvency issue moving forward. But the resilience of the credit space, to me, has been really surprising.
Yeah, well, I agree. I mean, not that it's been surprising overall, but that in particular the high yield space has underperformed in an environment where people would say, well, typically the more leveraged companies would get beaten up the worst. How do you explain this? I mean, do you think that we are entering a credit cycle that people are unprepared for, or do you think this highlights the resilience of balance sheets that have really gotten flush with cash and pushed out maturities?
I think that there might be some cases of resilience where the balance sheet might really be being reduced, but honestly, we've been getting even more selective over time on the high yield, and in general, we do prefer investment grade to high yield. So maybe it's more on the investors' irrational, this credit resilience so far.
What's your sense about whether there are any spots within the equity space to hide, or if this is really, at this point, something that needs to be parked on the sidelines?
Yeah, definitely. Well, from a regional perspective, we think that the U.S. economy is still in a better shape when compared to Europe, and this is justify our preference for U.S. equities versus Europe. Then, if you look at our sector allocation within Europe, staples, industrials, IT, and utilities offer some nice opportunity. When it goes to the U.S., also the banks in the U.S. seems to be extremely resilient, and the healthcare sector as well. On emerging markets, we've been moving to the cautious side, and we've been reducing also the exposure to China, which remains a really big question mark on what's next. We do believe that still the rebalancing has to take place in China, so far as the general economy.
Monica Defend, you'll be sticking with us. Coming up, Musk's Twitter deal facing yet another headwind, this time from the U.S. government.
I'm wondering how much Elon Musk is regretting this impulsive decision to buy Twitter. It's been a huge distraction. It's definitely affected the Tesla stock.
That conversation coming up right now, just 15 or 13 minutes into the session, and you are seeing the whippy action turn to losses. The S&P down 0.4%. This is Bloomberg.
There's been so many rumors about this Twitter deal. We don't know what is true and what isn't. And also, I'm wondering how much Elon Musk is regretting this impulsive decision to buy Twitter. It's been a huge distraction. It's definitely affected the Tesla stock.
There's been a lot of sagas, and this has been yet another one of them in the Twitter story. Bloomberg reporting that the Biden administration is weighing security reviews of Elon Musk's ventures, including his bid to buy Twitter. And of course, the department did come out and raise some questions about that after that report came out. Bloomberg's Ed Ludlow back to make sense of all of this. Ed, please help us.
Yeah, good morning, Lisa. There were 4 key reports on Thursday night, all about Elon Musk, all about Twitter. The first, as you said, according to Bloomberg sources, various individuals across various agencies in DC are looking at security reviews of Elon Musk and Elon Musk's businesses. This stems from his comments around the war in Ukraine, his comments around SpaceX's support for the use of Starlink in Ukraine, and of course, his purchase of Twitter. As you said, this morning, the White House has said it is not aware of any national security review of Musk ventures in response to that Bloomberg report. The Washington Post reported that Musk is telling potential equity partners in this Twitter deal that he will cut the workforce by 75%. Bloomberg has confirmed that he is telling investors that. Twitter, in a memo sent to his staff, which sources shared with me, say there is no plan for company-wide layoffs. There were talks ahead of the merger agreement being signed in April about cost-cutting measures, but once the agreement was signed, those talks end. No plan for company-wide layoffs. And most importantly of all, in the background, Bloomberg News reporting, according to sources, bankers and advisors on both sides of this deal are getting on with it. They fully expect to have a document in place and for the merger to close by the October 28th deadline put in place by the Delaware judge, 5 p.m. on that date. We're also reporting, according to one source, that key banks are just waiting for any day now Elon Musk to call in that debt financing, and there's no expectation that the banks will hesitate in providing that $12.5 billion of debt financing. Those are the stories.
Perhaps because they haven't found the loophole yet in the contract. I have no doubt that they're looking for it. Ed Ludlow, thank you so much. Twitter not the only deal under the White House microscope. For more, Bloomberg's Joe Matthew joins us with other companies facing some regulatory scrutiny. Joe.
Yeah, we moved to high tech in this case, Lisa. It's interesting, the conversation we were having just a couple of weeks ago about the United States cracking down on exports of high-end semiconductors, chips used for artificial intelligence and supercomputing. We add another layer here with Bloomberg reporting that the administration is now considering clamping down in a very similar way on AI software and technology that surrounds quantum computing. This is very high-end technology that kind of moves beyond the ones and zeros that could really change the shape of high tech in the future here. And the United States does not want China to get its hands on this in what is now really looking a lot like an economic Cold War. In terms of the companies here, it is that, by the way, moving stocks without any official announcement here. These are just reports and early planning here. But Nora Technology, Chinese tech firms like ACM Research and Piotech are trading lower, Lisa, as long as we're also seeing some U.S. tech companies developing this technology trading lower today as well. Think Microsoft, Intel, and IBM. But it's not just tech that could take a hit from regulators here in Washington, as we learn now that 2 high-ranking senators on the Judiciary Committee, Senator Amy Klobuchar, a Democrat, and Republican Mike Lee, are calling for a hearing now in the Albertsons takeover, or at least proposed a takeover of Albertsons by Kroger. This is the big grocery merger that's been in the works here. We knew this deal would face scrutiny. Klobuchar and Lee, top officials again on Judiciary, say they have serious concerns about the deal. Antitrust concerns Klobuchar is pointing as well in a letter now to the FTC, which still seems to regret approving Albertsons' takeover of Safeway a couple of years ago that resulted in a bankruptcy and some spin-offs here. So I would expect a lot more conversation about this following the midterms that will begin with a hearing on Capitol Hill and will likely trickle to the FTC, Lisa.
Great work, Joe Matthew. And I'm just looking right now at Albertsons shares shares down more than 24% in early trading, perhaps in the heels of some of the pushback that was, as Joe said, expected because of the big antitrust push by this administration. Amundi's Monica Defend is back with us. Monica, we haven't really talked about the potential policy risk because there is a feeling that markets are in charge. Do you think that that is true, or do you think that there is a policy risk that perhaps is underappreciated?
I think that the UK really was an extreme case where we have seen how the trade-off in the policy might actually blow up and have dramatic consequences on the market. So it's really this combination of fiscal and monetary policy at a time of very different target, because fiscal has to support the economic path, while central banks and monetary policy have to carve out inflation, to reduce inflation. So these two conflicting targets might really explode, as it has been the case in the UK. So hopefully this will be an insulated case, but definitely this is one of the risks we have on our radar.
How much does this really reduce how much borrowing there can be by governments and fiscal spending because of the bond vigilantes that have definitely spurred up?
Well, you really need to look at region by region, because, for example, in Europe, we have the other difficult task of fiscal solidarity, for example. So you have many countries that have to vote on unanimity in order to get a package, an energy package that can help the population. It is really not the same in the United States, where, if you want, there was more desynchronization between fiscal and monetary. Honestly, it has been only in China where the two in tandem have been working together. But really, apart the bond vigilantes, I think that top down we might have an issue of a policy trade-off and a mistake.
Monica Defend, thank you so much for taking the time. Truly wonderful. Have a wonderful weekend. Monica Defend there of Amundi. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. We did see some flip-flopping action ahead of the opening bell. We still see that flip-flopping action. The S&P now up about 0.5%. It just highlights the real uncertainty and concerns about liquidity and where the next shock is going to come from. Lack of conviction. This is Bloomberg. Time now for the trading diary, but before we get there, let's take a look at the flip and the flopping. Wow, it is flipping and it is flopping. The S&P now up 0.7%. Blinken, it might be down just as much. The NASDAQ up 0.4%. This comes as we see a retracement in the yields. They had been much higher. Now they're just a little higher on the long end. The short end, you're actually seeing yields come down. 10-year yields 4.26%. The 2-year yield 4.53%. This is the trading diary, what you need to be watching into next week. President Biden discussing the U.S. deficit at 11 a.m. Eastern. Looking ahead, U.S. PMIs on Monday. Tech earnings ramping up with Alphabet and Microsoft on Tuesday. Meta and Twitter reporting on Wednesday. And finally, U.S. jobless claims and core PCE, followed by an ECB rate decision and Lagarde press conference on Thursday. One thing that is notably absent is Fed speak because it will be the quiet period starting on Monday. This was Countdown to the Open. This is Bloomberg.
Great questions. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on this Friday, October 21st, and here are the top market stories we are following this hour. Bracing for intervention, yen falls to a 32-year low despite warnings from authorities about stepping in, and investors are anxious. The jitters in Snap and Twitter are forcing big losses in the social media stocks. And watching the bottom, Bank of America's warning that we haven't seen capitulation in equities yet. From New York, I'm Sonali Basak with my co-host in London, Guy Johnson. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, I'm excited to go global with you on this yield story. It's kind of crazy what you're seeing in markets across the world.
There's so many elements to it, Shonali. You've obviously got what is happening with this journal piece and the impact that that's had a little bit earlier on. How does the Fed finesse going from 75 to 50? That's a big question. You've got what's happening with the yen. That feels like a ticking bomb waiting to go off in these markets, doesn't it? You've got the UK story into the mix. You've got an Italian element as well in the mix this afternoon. We could have an Italian government, a new Italian government led by Meloni a little bit later on. So, Shonali, yeah, I think it's multifaceted, but the story at the moment is that yields continue to go higher, and that's a problem, and the rate of change has been quite something this week.
Quite stunning, Guy. And, you know, if you look at it, it's even the Swissy, too, if you want to pile on more areas of trouble in the market here. And the question is, into next week, what do central bankers really do here to stave off the troubles in market? Do they continue course? Do they start to rewind?
Yep.
That big pivot is a big conversation.
Yeah, and what is, I think we need to define what a pivot is as well. Does going from 75 to 50, is that a pivot? Or is a pivot going from raising rates to doing nothing, or is the pivot doing nothing to going to cutting? I don't know. I think those are all things we maybe need to define. So let's talk about it. Let's figure out kind of where we were. We were kicking this around a little bit earlier on, trying to figure out what our question of the day is. Clearly, as Shonali mentioned, we are seeing maybe yields easing off just a little bit after that journal piece reported that maybe Fed officials are debating the pace of their tightening after November going into December. But our question of the day is a fairly straightforward one. Have we reached peak yields? Joining us to discuss, we've got an all-star cast lined up. Bloomberg Intelligence Chief U.S. Rate Strategist Ira Jersey, who I've had the pleasure to meet in person this week, which was fantastic, and Bloomberg's Christine Aquino. We are well acquainted. Ira, let me start with you. What did you make of the journal piece?
Yeah, so I do think that, you know, you mentioned pivots, Guy, and I do think that this is just one of many pivots that the Fed and maybe other central banks will ultimately have to make. But it's always been about the pace of hikes for the Federal Reserve. So the idea that we had the pretty high CPI print and maybe now they're going to only hike 50 in December instead of 75, I think is meaningful to markets, and it's one of the reasons why you've seen the steepening of the yield curve, which is not something that I would have anticipated, before the journal piece came out. So I do think that it matters. I do think that Fed officials are worried about maybe going too much, but they still really fear inflation and not doing enough. So for me, and like if I were one of them, I would say, okay, let's go a little slower, but maybe we can go more at some point in the future if we have to.
Walk us through the cross currents here, Christine, because of course we're watching yields alone, but we're also watching currencies around the world, and you're seeing some stress in some seriously large markets that investors are exposed to. What are the biggest risks here heading into next week?
Well, Shonali, I think we're definitely seeing it in yields, of course, but we're also seeing that cross-current feeding through to a stronger dollar yet again, and signs of the pain that is inflicting around the world. Of course, we know that the Bank of Japan, or the Japanese authorities in general, they had previously intervened in the yen. We're seeing that yen weakness story continuing again, and everyone is very much on the lookout. Where are the Japanese authorities? At what point will their pain threshold be broken by this move? But we're not just seeing that from Japan, right? We're seeing it from China. We're even seeing it from smaller countries such as the Philippines, my home country, which I know for a fact, just hearing from my relatives abroad, that they are very much feeling that pain of a weaker peso and a stronger U.S. dollar, very much a result of this higher yield story.
Just go back to the yen for a moment. 151, 152, 150. Where's the line? Does anybody actually have an idea here? And where are the big stress points for the market? Because I'm wondering kind of how the market is set up around this story. Where is the market positioned for the yen right now?
Well, Guy, I think what people are really looking out for when it comes to yen intervention is two things, right? I mean, the absolute level, as you were mentioning, but I think that has been a futile exercise in trying to figure out the exact level, just because initially it was 145 and then it became 150. We're now past that point. And so I think it's less about the level and more, from the Bank of Japan's perspective, it had always been a more fruitful exercise in intervention if they knew that the market was already heading their way. And so I think this is what kind of investors are trying to gauge now is at what point will we see that yen kind of starting to turn so that the Bank of Japan can come in and whack it in the direction that it desires. Exactly.
I think, Ira, you had mentioned the yield curve for a second back here in the United States. When you look at the 10 to 2 year curve. What does that even mean anymore, the fact that it's less inverted? Does that mean that the pivot is more justified because of less of a fear of a harder landing? Or is this just a trading glitch, frankly? Are we watching flows and levels here rather than paying attention to the reality of how much longer this might go on for?
Well, I think it's a little of both, and the idea that when the Federal Reserve is going to maybe not hike as aggressively, that's one of the reasons why people get out of their flattener trade. So I think firstly it is partially positioning. A lot of people are in yield curve flatteners. They do think, and I'm in this camp, that I do think that the yield curve could potentially flatten significantly more than we've already seen. But I think that people get nervous when they think about maybe the Federal Reserve getting a little bit more, I should say, less hawkish. And in doing so, they wind up with a significant positions that they have to get out of. And market liquidity has not been particularly good. And I think that you're going to continue to see pretty big moves in these very crowded positions.
Ira, which asset class is in charge of this narrative? Is it what is happening in the bond market right now, or is it actually the Fed's fear of a big equity rally were the pivot to be misperceived?
Yeah, that's an excellent question. Obviously, all the markets are very highly correlated. I do think that that the bond market still is taking front and center stage here, and the Federal Reserve is going to worry about financial conditions being too easy for too long, like we mentioned. But that's going to manifest itself in things like big moves in the yield curve, like we've seen. To go back, just like really quickly, Guy, if I can, to go back to the discussion about the yen and about what's going on in Japan. When you look at the Japanese yield curve, remember they're still doing yield curve control, so they want to keep the 10-year Japanese government bond at 25 basis points, but not necessarily the long end. So you've seen a significant steepening in the yield curve in Japan, where now that yield curve is over 125 basis points between between the 10-year and the 30-year. I think that there is a big risk here to global markets, where if the Japanese do get rid of yield curve control, you can wind up seeing ramifications, at least in the short term, all around global developed market sovereign yields, and you can wind up seeing very significant moves very quickly in Europe in particular, I think.
Super quick here, Christine, really one-word answer. There's something you have to break here. What is the most crowded trade in the currency market?
Well, it's looking like a strong dollar, Sonali, and I think, once we get that story of a potential Fed pivot, whether it's by the end of this year or early next year, I think that one in particular might be quite the pain trade.
Peak yields, peak dollar. We'll be watching at Bloomberg's Christina Aquino and Ira Jersey of Bloomberg Intelligence. Thank you so much to both of you for your time. And coming up next, we're going to continue our conversation on the bond sell-off and ask Julie Biel of Kayne Anderson Rudnick whether we've seen that peak in yields. This is Bloomberg.
Earnings season is here.
Markets bracing for another big earnings season.
Everyone is expecting it to be poor.
We had big markdowns on earnings.
Bloomberg breaks the numbers
The
first.
bar has already been set pretty low.
The big question is, can it go lower? We're seeing some pretty bad earnings already from those who have reported.
With exclusive expert analysis.
Which aspects of the market are not sufficiently priced?
Is this a macro huge headwind?
There is some really bright light at the end of this tunnel.
When is this floor going to come? When can I start buying?
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We're seeing these yields in the 10-year that we haven't seen since, 2007. You have a large correction, particularly in fixed income, and mostly due to the rise in interest rates, and whether it's high yield or equity, investors are compensated by that risk premium, given that we have seen this rise in interest rates. And overall, in our opinion, I think the fixed income market is a little bit ahead of the equity market, particularly the U.S. equity market.
That was Leslie Falconio of UBS earlier on Bloomberg Surveillance. We are watching that sell-off in bonds today, which takes us back to the question of the day. Have we reached peak yields? Joining us now is Julie Biel, a portfolio manager at Kayne Anderson Rudnick. Julie, when you think about the question here at play, how high can yields go here? How far does the Fed go here? What does a pivot even mean?
Yeah, it's hard to think that the pivot is anywhere on the horizon when you think of the components of inflation that are just so sticky, and they're large components, right? Shelter is a very large component. And I think it's hard to argue for rates being, topped out here when it's clear that there's still a lot more work that needs to be done in terms of tightening here in the U.S. and abroad as well.
So, Julie, if that's the case, how should we think about the Fed? The Fed's going really aggressively at the moment. It's going at 75 a meeting. How would markets react for the Fed going from 75 to 50? Would that be seen as being dovish? Should it be seen as being dovish? How would you read it?
I think it's just a testament to how much the world has changed for us, right? Where the initial first, if you think of that 50 basis point increase, the first one that we had, it was like the world was ending. And now that would be an absolute relief. I think it would create a real relief rally that, oh my God, we've reached peak inflation. And, I think it's possible that we're at peak inflation, but the thing is you have to think about, so what is going to bring inflation down? We need proper deflationary forces in order for that to happen. And I'm not really seeing how that's happening on the horizon, right? Because a lot of the places where you're getting deflationary pressure is on discretionary purchases more so than truly things that you need to have. So I think long term, you have to think about where we are in the cycle and that the cycle still matters.
The cycle is interesting here because there's a lot of question around whether they start to cut at some point, but the idea here that they might hold at a higher rate is equally interesting. What you're saying about inflation being stickier for longer, I think the key question here, Julie, is how long? Does this pain last well into next year, maybe even the year after?
Yeah, I think all of the members of the Fed are thinking a lot about the 1970s and the period of stagflation, right? And I think everyone knows that the real risk is that you take your foot off the accelerator too soon and inflation roars back, and then we're just in this yo-yo where it's really not helpful for anyone because all that's happening is just a major erosion in purchasing power. So I appreciate that everyone feels like, well, the Fed is just going to raise blindly until something breaks. There's no breaking. Like, cycles are a normal occurrence. They occur in nature and they occur in markets. And so there's nothing broken about a recession. It's just a normal process that kind of has to happen every 7-8 years. We're 13 years into this bull market.
If we're going to get a recession, therefore, you would have thought we'd get a big one. If we're going to get a big one, what are your key trades, your investments in that environment?
So I think it's hard to know what this recession looks like because we have no comparable period where we've had this level of liquidity, this level of low interest rates for such a long time, this level of stimulus, this level of dislocation from an exogenous factor being the pandemic. It's really like you don't have anything that you can really look to that's a good analog. So I think the businesses that I'm the most interested in are ones that have high levels of recurring revenue and durable protections around them. So I like the businesses that are in software, but not so much the ones that are like, hey, buy my software, I'll help you drive more revenue. I want the businesses that are, my software helps you cut your costs and be more efficient, because I think that's going to be a very compelling sale, even in a downturn.
So that's the global, the sector trade, but what about the global trade here? Are you seeing better opportunities that are not in the United States, given those dislocations you're seeing in other markets like the UK?
Yeah, I think generally speaking, the consensus is, oh my God, I want nothing to do with the UK. It's just such a basket case. And for sure, like from a currency standpoint, you have to be a little bit thoughtful. I mean, I do with love. I say it with love, right? But I think actually, if you look at the UK, particularly the housing market, there are interesting things that are dynamics that occur in that market. So, half of the real estate is owned outright, so that gives it some kind of stability. And, something like 2/3 of mortgage of home sales have to happen. They're either from, debt, divorce, or death. So I like the company Rightmove, which does, listings for real estate, because I think it has a certain base business that's not really going to go away.
Julie, I feel the basket case. Honestly, it's how we feel at the moment. It's a tough place to be in the world, believe you me. We hope it ends soon. Julie, thank you very much indeed. Julie Beale of Kayne Anderson Rudnick, greatly appreciated. Yeah, it's going to be an interesting weekend. Still ahead, what ETF flows are telling us about the sell-off in bonds. That's next. It's ETF Friday. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. American Express has slumped after it set aside more for bad loans than analysts had expected. It suggests rising interest rates could start hampering customers' ability to pay their bills. Provisions for souring loans were $778 million in the quarter. That is worse than the $573 million analysts in a Bloomberg survey were expecting. Credit Suisse will aim to settle a tax fraud and money laundering case in France on Monday. The Swiss lender is reportedly in the final stretch of negotiations with prosecutors to reach an agreement that would include a fine, but no admission of guilt. The size of the settlement is unknown, and the deal could still fall apart ahead of the court hearing. And Adidas has issued a fresh profit warning as unsold goods pile up and consumer demand weakens across China and Western markets. The German sportswear maker says it now expects an operating margin of 4% this year. That is down from a prior forecast of 7%. The CEO, Casper Rorsted, has already announced he's stepping down next year. And that is your latest business flash. Sonali.
Thank you, Ritika. It's time now for ETF Friday. Exchange-traded fund investors are preparing for that possibility that peak bond pain has passed as TLT and LQD call option interest hovers near all-time highs. And it takes us back to our question of the day. Have we reached peak yields? Joining us now is Bloomberg's cross-asset reporter and host of Crypto IRL and ETF IQ, Katie Greifeld. Katie, what do these ETFs say about the bond market here? I think we focus way too much on equities, but there's a lot of trading here that is worth paying attention to.
If you dial down and look at the flows, I was looking at fixed income ETF flows overall for the year. This is so interesting. Right at the top of the leaderboard, you have BIL, which is a T-bill ETF, and then you have TLT. There's like $100 million separating the both of them. Both are nearing $13 billion in inflows. So people are flooding into both ends of the Treasury curve. If you look at what's happening in the price action, it doesn't look like we're at peak yields, but it looks like a lot of people are positioning for that, hoping for that, just given the magnitude of this sell-off. Surely it's got to stop at some point. That seems to be the mood music in the market right now.
What are the options markets telling us about this story as well, Katie?
It really backs it up what we're seeing in the flows. If you look at TLT, again, that's that 20-year Treasury ETF. I was looking at call open interest earlier this week. It's close to a record high. This fund has been around since the early 2000s. It's seen a lot of different cycles and still call open interest at close to a record high. If you look at its put to call open interest, it's at a record low. So that's backing up what you're seeing in the flows, the options market and the inflows on the same page. The only thing that's missing is a bond rally. That hasn't yet worked out. Not sure what the trigger will be here, but again, investors really positioning for that just upward soaring yield to sort of come off the boil here.
How much do they feel the need to hedge here, and are there options available here to kind of protect against being wrong?
It's really tricky. I mean, bond market volatility has really been the name of the game for over a year here, and you've seen a lot of ETF issuers try to seize on that moment, sort of issue these products to hedge against volatility, to hedge against inflation. Turns out that's a really difficult thing to do. There is one ETF that is absolutely soaring this year. It's the Simplified Interest Rate Hedge ETF. The ticker there is PFIX. This basically invests in a bunch of different swaptions that make it functionally similar to a put on long-dated Treasury bonds. It's up 116% year to date, which is a really dominant performance. But this one is interesting. You've seen a lot of flows into the traditional bond ETFs, but if you look at the inflows into this fund, we're only talking about $126 million. So there's a big gap here between performance and where investors are actually putting their money. So it's not an all-out rush into bonds, I would say.
So where does that leave us cross-asset? Let's go to your kind of bailiwick. The relationship between bonds and equities. I'm trying to figure out which one's in charge, because the Fed, I think, is going to be paying attention to this.
I think in a lot of ways it's the bond market that's leading here. And if you look at what's coming through in the equity inflows, you are seeing inflows into the likes of SPY, into the likes of VOO, sort of these big index tracking S&P 500 funds, which tells you something, that people are nibbling at equities here, trying to call a bottom as they really put their money behind maybe calling the top in bond yields, but not getting too fancy with it. Again, just going into these S&P 500 broad, passive funds. So there is an appetite there, but it's, again, it's pretty simple and cautious at this point.
You know, Guy, before she covered ETFs, she covered rates, so lots of bailiwicks here.
Oh, yeah.
I'm really curious here.
No, I was saying she got both. She's cross-asset. She has both.
She's everywhere. Katie, what about
everything?
What about risky debt? What about HYG here?
It's really, this truly is a Treasury market trade. I think that when you think about LQD, when you think about HYG, both blue chip and the high yield bond markets, it's just following in tune with what we're seeing in the Treasury market. So as the money is going into these Treasury market funds, you are seeing some interest in trying to bet on the credit market. LQD call open interest also nearing those record highs, almost there. But again, the price action not cooperating, Sonali.
And is there an expectation that we go even wider from here?
That seems to be the case. I mean, we'll see how this round of earnings comes in. The companies have been missing expectations, which have already been lowered. A lot of people are saying, a lot of the strategists that I talk to, that should translate into wider credit spreads from here, but I don't think anyone is quite calling for a real break apart there.
I know she's got skills. Katie Greifeld, thank you very much indeed. Fantastic. You can, of course, catch Katie a little bit later on Wednesday, ETF IQ, 1 p.m. New York time. Fantastic show. Well worth watching with Matt Miller. Coming up, Twitter shares are tumbling on potential U.S. government scrutiny of Elon Musk's ventures. We're going to talk about this. This isn't just a Twitter story. This isn't just an Elon Musk story. It's also related to what is happening with what is going on with Starlink and Ukraine. There's all kinds of aspects to this. What does it mean for the merger arbitrage trade around all of this? Julian Klimachenko is going to be joining us. Accelerate Arbitrage Funds. That conversation is coming up next. This is Bloomberg.
We are 1 hour into the U.S. trading session, and Bloomberg's Kriti Gupta is tracking the move.
Yeah, a little bit green on the screen, Sonali. It's kind of interesting because we are actually ending the week on a high note. Look at this. The S&P 500 up about 0.5%, and you were comparing that to the NASDAQ. A little bit of outperformance in the S&P 500. Remember, today you have about $2 trillion of options that are expiring, and this is going to create these kind of windows of liquidity throughout the day. So perhaps prepare for a little bit of a choppy trading session ahead. Snapchat is going to be a major mover there, though, down at 30%. but gone are the days where one stock on macro concerns is going to tank the entire market. A 30% move in Snapchat is not really affecting the S&P 500, or I should say sentiment broadly. The 10-year yield not far behind, really kind of unchanged, only up about 1 basis point. That's just today, though. Look at the long term. You can see a lot of pain in the bond market. The selling just hasn't stopped. This is actually a 12-week run of how much pain you're seeing across the curve in U.S. Treasuries. The question is, how high can yields go? How high can rates go? And is this really all driven at the end of the day by the peak policy rates being priced in for the Federal Reserve in 2023? But let's bring it back to the stock market here, because like I said, poised for an up week. On the 5-day chart, we're looking at 3% gains. That is the best weekly run going all the way back to July. So like I said, some good news there. And if we can actually just look at the next board here, what's crucial and very, very crucial, massive emphasis on this story is simply going to be, once again, the rates picture. I'm going to go back and forth because a lot of that rates picture is affecting some of these single stock names. Take a look at KeyCorp, for example, one of the major companies there, up about 3%. We're looking at Fifth Third Bancorp as well, not far behind, up about 2%. The rally, where you are seeing green on the screen, guide, it's actually fairly broad.
Critty, I'm fascinated what you said about the Snap story. I think it is quite a macro theme, so I'm surprised that actually the market is reacting in the way that it is. I think this could be read across into a number of different areas right now. Critty, great stuff. Thank you very much indeed. Shares, as Critty says, of Snap plunging sharply today. This after the company posted its slowest quarterly sales growth on record. As you can see, the stock is down pretty precipitously today. It's down over 80% thus far this year. Joining us now for more on this story and everything else that is happening out there on the tech landscape this afternoon, because it's busy, to say the least, is Ed Ludlow. Let's start with Snap. Sure. Then we're going to migrate our way through Twitter and Starlink and Apple and everything else. So let's start with Snap. Ed, I'm surprised the market is taking this and not running with it and extending it into other areas, because this feels like a macro story to me. This feels like evidence of a significant ad slowdown, and the call I thought was fascinating.
Yeah, so I think the big question is how transitory are these headwinds for Snap in particular, and how permanent are they broadly for social media companies with an ad-based model? The granularity in the earnings statement was worth paying attention to. The wording was worth paying attention to. Advertisers are cutting budgets. Advertisers are pulling back. Inflation is hurting the consumer, which is spooking advertisers. There's also the aspect, right, of the iOS ad tracking platform changes. And it's really funny because we spent so many quarters waiting for that to have an effect, particularly on Meta, the parent company of Facebook, right? But it's clearly having an effect in Snap's case as well. It's as if the shock took the market by surprise, because if you think about what happened following the war in Ukraine at the outset of that and how that impacted the advertising market, particularly in Europe. Snap was already a stock that's down 77% year to date, right? Now it's down, 100% year to date, down from an $80 stock last year. It continues to get worse, I guess, is the point that I'm making.
Ed, I want to kind of point out some news here that's crossing the wire on the Bloomberg terminal. That's Apple's design chief is leaving after 3 years. That's Evans Hanke. You are still seeing Apple shares up on the day, but a little pressure on the stock here. I'm wondering, put this into context here on what this means for Apple. That seems to be a very big deal.
Yeah, so sources are telling us that Evans Hanke notified staff she'd be leaving the company this week. She's going to remain in post for 6 months. You know, she leads a pretty important team. Those beautiful iPhones are beautiful for a reason. Go back to the 90s and the history of Apple. This is kind of the first time that the company's not going to have a de facto design chief in place. That's on the hardware side. On the software side, that design lead is staying. Apple is a company where continuity is king. That's why this is important. But again, look to the future. AR, VR headsets are in the works, an EV potentially in the works. She would have had a role in that too.
Mark Gurman's going to join us very shortly. We'll get more details on this story in just a moment. Ed, while we wait for Mark, let's talk a little bit about what is happening with Twitter. Actually, let's think more broadly about what is happening with Elon Musk.
Sure.
There is some concern that the Twitter deal is going to be potentially being impacted by regulatory oversight of that deal, but more broadly of what Elon Musk is up to. Is this a Twitter story, or is this a Starlink story? Is this a Russia story? Can you pull all these threads together for me?
Yeah, it's a mixture of all. You know, Bloomberg sources tell us that different government agencies in DC are looking at their options and considering how they would do a security review of Elon Musk and Elon Musk's companies. Why? Because of the comments that Elon Musk made around the war in Ukraine, because of the threat, albeit a short-lived one, to pull support for the Starlink system in Ukraine, and yes, because of his deal to buy Twitter, which while it has a small user base, has outsized societal influence. And sources tell us that one mechanism that they're talking about is the use of CFIUS, right? So this is a man who would own a big portion of the modern world, frankly. You know, the market incumbent for EVs, the dominant player in private commercial space, and this very important tool for SpaceX. Essentially what we're hearing from sources is DC's antagonized, and they're looking at what to do about it.
Bloomberg's Ed Ludlow, thank you so very much. And for more on the latest Twitter events and what it could mean for merger arbitrage is Julian Klimachko, Accelerate Arbitrage Fund Portfolio Manager. Julian, you know, we've been talking a little bit here about the Biden administration's concerns here, national security reviews potentially. We've reported here over at Bloomberg News that includes for a deal like Twitter. And I'm wondering, for a portfolio manager, folks have been tossed around all year in this deal. There are some who have kept some real conviction. David Einhorn making it his biggest long of the year. How do you feel about the prospects of this deal getting done anytime soon?
Well, happy Friday. Thanks for having me. And the Twitter deal certainly has been extremely volatile ever since it got announced. If it wasn't one thing, it was another. First, you had all the drama with the lawsuit, and that seems to be calming down. And then there's the financing and Tesla stock, and now there's noise with respect to CFIUS, the Committee on Foreign Investment in the United States. And note that government agency, it regulates foreign investment. And I will note that Elon Musk is not a foreign investor. So I fail to see how that would be applicable to this deal in particular. And should note that also the Twitter deal is not subject to CFIUS approval. As the company stated, all conditions have been satisfied and is expected to close October the 28th. And currently the market price, again, roughly a 90% chance. If you look, a deal price $54.20, trading around, 49 and change, 50 and change. So you got roughly 4 up and say, $30 down. That is, 10% chance deal break. So the market still quite skeptical on what's going to happen here.
Yeah, what do you think, Julian, what should the price be?
Well, the price should be volatile. I think the stock trading down on this CFIUS rumor is a bit overdone. My view is that this deal will close October 28th, but that's to be seen. So I think it's a good opportunity.
It's interesting because, to your point, the more the stock trades down, if it does close, it's a nice profit opportunity. When you look at merger arbs this year, they're one of the few types of strategies, according to Bloomberg indices, that are up on the year. So where's the opportunity and where are the pain points?
Yeah, that's a really good point, because merger arbitrage is a low duration, absolute return strategy that theoretically should not be affected by the equity bear market or the bond bear market. And for an arbitrage, if you can generate a 10% return in a week, that is exceptional, especially in the fourth quarter heading into year end, where you do want to show that positive performance for your investors.
Julian, do you think, though, that we are going to see more regulatory scrutiny, and is that going to make it harder to judge whether or not some of these deals ultimately will close?
Yeah, that's a great point. Specifically on the antitrust front, you've seen a lot of noise from the FTC and the DOJ, and those regulatory agencies getting quite aggressive in suing to block deals. In the past month, we saw the DOJ lose 3 merger challenges, so it hasn't gone well with respect to being more aggressive in terms of challenging mergers. Nonetheless, you look at some of these deal spreads, Albertsons, Kroger, for example, and it's so wide you could drive a truck through it. So merger arbitrageurs in particular, and the market in general, is very, very concerned just regarding antitrust noise. But I think that's all it is noise. And a lot of these deals where the spreads are very wide, I think they will close on the terms as expected.
Julian, always great to catch up. Really useful insight into what is happening here. Julian Klimochko, Accelerate Arbitrage Fund Portfolio Manager. Thank you very much indeed. I want to take you back to that Apple story that we broke just a couple of moments ago. Apple's industrial design chief, Evans Hankey, is going to be leaving. Why is she leaving? She's been at the company for around 3 years. Let's talk about the implications. Mark Gurman broke the story for us a few moments ago. How should investors read this, Mark? What should they be reading into this?
As we know, Apple's key differentiator is its design, right? The iPhone with its all-screen, the Apple Watch, the super thin iPad, its Macs. From the very beginning of Apple's resurgence, the beginning of the 2000s, it was all about design with that new iMac and colors, with the iPod, the original iPhone. So design is super core to Apple. And now their top industrial designer, this is the person in charge of designs of its hardware products, is departing the company. She's only been in this role for 3 years. She had been at Apple for about 2 decades, working under Johnny Ive, who, as we all know, was Apple's chief design officer before leaving 3 years ago. So this is a considerably, huge development for the company, especially for its design ranks and top of the company's leadership.
You've reported also that the design head for software is still sticking around. You've reported also that there are hundreds of industrial designers that had worked under Hankey. So what does this mean for the operation at large? Does it mark a more significant shift for Apple?
Yeah, this is a significant development for Apple, of course, and they have not named a replacement. The company informed its teams this week that Hankey would be leaving, and they have not named a replacement. She will be remaining at the company for about 6 months or so as part of a transition, and hopefully we'll know more about who the replacement is.
Nice story, Mark. Really enjoyed reading it. Thank you very much indeed. Mark Gurman joining us on the latest from Apple. Coming up, we're going to switch to what is happening in the commodity space, a potential diesel crisis in the United States. We're going to discuss that with Francisco Blanche, Bank of America's Global Research Head of Global Commodities and Derivatives. That's next. This is Bloomberg. of FX movements over the last few minutes. So you've got the yen down fairly sharply. You've got also the Swissy on the move as well. Both of those two seeing a very similar move, as you can see. This is dollar yen. We're now trading 150. We're back to 150. Remember, we got up to nearly 152. But as you can see, significant a leg lower being taken here. We've also got a bit of a move when it comes to the Swissy. The Swiss franc is now trading, against the dollar just north of 1. So some fairly big moves here. You're also getting a pop in the euro as well. Let's pivot and talk about what is happening in the commodity space right now, because you're going to need to pay attention to this one. US diesel demand is surging, but supplies are basically, and stockpiles are at their lowest seasonal level ever. I've got a great chart which we can put up for you and show you this. Diesel, remember, is used in the United States for heating, it's used for trucking, and there is a shortage, and that's going to be a problem for the Biden administration this as we head into winter, and of course the upcoming midterms. National Economic Council Director Brian Deese addressing these issues a little earlier today.
We need to see, as the industry, build those inventory levels so that we don't put ourselves in a situation. To your question about exports, the president has been very clear and will continue to be clear. At this moment, when we have uncertainty for American consumers, we have to keep all options on the table. That's what we're doing.
Brian Deese, Francisco Blanch, Bank of America's global head of research, commodities, derivatives, joining us now from Madrid. Francisco, how big a problem is this diesel story, and what can the administration do about it?
Hey guys, thanks for having me. It is a huge problem, in fact, if you look across the commodity spectrum, we've been arguing there's commodities that are in a good situation, some that are in a bad situation, and some that are in an ugly situation, and diesel definitely qualifies as an ugly situation commodity because of three main reasons. Reason number one is that we've had a huge disinvestment in refining capacity because we had weak demand throughout the last couple of years during the pandemic, and then of course we were all moving quickly to an electric vehicle future that's maybe taken a little longer than we expected, as we've learned with Tesla. But so I think we've lost about 2 million barrels a day, 2% capacity on refining that we were, is now coming back to haunt us. Second factor is the very, very high natural gas prices globally. Remember, high gas prices hurt refining margins because gas is a key input into the refining process. This is what we use to burn crude oil to create diesel. Essentially, that's gas. So that's not helped either. And then the third factor, really on the supply side, which has been a big problem, is sanctions on Russia. The U.S. was the first country to impose sanctions on Russian diesel, then the U.K., and now, of course, over the next couple of months, we're going to see Europe doing the exact same thing. So, and Russia is the world's second largest exporter of petroleum products, including diesel. So that's where we are today, guys. This is very problematic.
The urgency here is pretty incredible, just days of diesel supply. What does this mean heading into the midterm elections and the broader inflation story?
Well, look, I think one very important message is hopefully the U.S. government does not take the steps to restrict exports because, again, Europe is essentially trying to sanction Russian imports of diesel. So, and of course, we've already heard from the U.K. regulator, where you guys are at, right, that there could be blackouts during the 4 and 7 p.m. on cold winter days. So Europe needs the energy. I realize high prices do not help anyone, but ultimately prices are a mechanism to spread around the limited available supplies, and that's what we have right here, right now. We need to let prices do some of the work on distillates, and I think it would be very damaging to start using non-market measures such as restrictions in order to support U.S. consumers, but at the same time really hurt European consumers that are already facing a very dire situation at home.
Francisco, let's talk about Europe, therefore, just for a moment. Europe's talking about price caps on gas. Do cargoes go elsewhere? Are the Germans right or are the Germans wrong?
I think the Germans are right on this one, but one important element that has worked, particularly in Iberia, we've seen the Iberian exception, which essentially we've seen the gas price and the power price being dissociated. So essentially, you cap the revenue that you're generating from those wind and windmills, those solar panels, and you cap the price there, nuclear power, and then essentially you just try to find a way to pay for the rest, as opposed to let electricity be priced at the marginal cost, which is what the system is intended to do. But unfortunately, all the deregulation of the last 20 years has been thrown out the window with Russia playing around with the gas supplies and restricting its volumes into Europe. So I think on the one hand you need to attract gas to the region, on the other you need to protect consumers, and that's the tough balancing act that European governments need to deliver. And just making things more difficult, each nation has their own energy position, their own infrastructure issues, and their own government balance sheets. I mean, one of the big issues in the UK, of course, in the last month has been the energy subsidies, which have fed through into the budget, into the mini budget, and then again into the kind of the financial turmoil we've seen. A lot of it's been driven by energy. Let's not forget, it's not just cutting taxes on the rich that was an issue. I think many of the European governments are very stretched because they're having to pony up a lot of money to subsidize consumption, which is something that generally financial markets don't like to do. The financial markets want to pay for long-term investment plans that are going to improve productivity, not plans that are going to go straight into subsidizing consumption of something that, frankly, we don't have.
Francisco, when you kind of look at the price movements across energy markets right now, what are the most mispriced relative to the cross currents that you're keeping an eye on?
Right. So I think, certainly probably the one market that's rolled off quite meaningfully in the last couple of days has been natural gas, and part of it is that the first few days of November look a little warmer than expected, so inventories are at reasonable levels. So the market is losing out some of the risk premium that was built into the early weeks of winter. So that's what's going on right now. I think distillates remain very, very constrained, and I think refining margins generally are going to stay high. We've seen gasoline as well, gasoline crack spreads going up again. The one market that has been a little impervious to everything else has been crude oil, and obviously OPEC has got some production there. The U.S. government has also announced they're going to buy crude oil below $70 a barrel to put into the SPRs. Now we have essentially two puts on crude oil, one from OPEC Plus and another one from the U.S. government. So I think crude oil is the one market that looks more interesting to me because the downside seems limited given the actions that we've seen on both ends. But yet the upside is a bit of a question mark here because remember, as of December 5, Europe is going to impose sanctions on Russian exports, and then of course we're going to have a price cap as well. So to me, probably crude oil looks like a more interesting market in the energy space at the moment, going into those December 5 sanctions.
Looking forward to keeping an eye on it with you. That is Francisco Blanch of Bank of America. Thank you so much for your time. This is Bloomberg.